Use of policy decisions to meet cash needs of the entity. Financial strategy revolves around three core policy decisions: investment, financing, and dividends, which together determine how an organization generates and uses cash. Managers must evaluate capital requirements for both long-term investments, e.g., fixed assets, expansion projects, and short-term operational needs, working capital. If internal funds are insufficient, external financing such as debt or equity must be raised. Dividend policy also affects available cash because profits retained in the business can be used to fund growth or strengthen liquidity. These decisions are interrelated. Higher dividends reduce available funds for investment, while increased borrowing can finance expansion but raises financial risk. Effective financial strategy therefore balances these policies to ensure adequate liquidity and support organizational objectives. A key policy decision concerns how much cash an entity should hold as a buffer against unexpected costs or fluctuations in operations. Holding too little cash exposes the organization to liquidity problems and possible insolvency if obligations cannot be met. Conversely, holding excessive cash has an opportunity cost because idle funds could otherwise be invested in profitable projects or returned to shareholders. Financial managers therefore aim to determine an optimal cash level that balances risk and return. Maintaining adequate liquidity also provides flexibility, allowing the organization to react quickly to investment opportunities or strategic changes without needing to raise finance immediately. This flexibility is particularly valuable in volatile or competitive markets. Financing policies must also consider the appropriate mix of funding sources, such as retained earnings, debt, and equity. Each source has different costs, risks, and implications for financial performance. For example, debt financing provides tax benefits through interest deductibility but increases financial risk and potential restrictions through debt covenants. Equity financing reduces financial risk but may dilute ownership and require higher returns from investors. Managers must therefore evaluate the organization's capital structure carefully to ensure it supports the entity's cash requirements while maintaining financial stability. Matching the maturity of financing with the life of assets, such as using long-term finance for long-term assets, helps maintain liquidity and reduces refinancing risk. United Nations Sustainable Development Goals. Overview of the Sustainable Development Goals, SDGs. The United Nations Sustainable Development Goals, SDGs, are a global framework of 17 goals designed to address major economic, social, and environmental challenges. They aim to promote sustainable development by addressing issues such as poverty, inequality, climate change, education, and economic growth. Organizations across both public and private sectors increasingly align their strategies with the SDGs to demonstrate responsible business practices and contribute to global sustainability efforts. Integrating SDGs into corporate strategy also enhances transparency and accountability in environmental and social performance. Strategic relevance of SDGs for organizations. Incorporating SDGs into organizational strategy can create long-term value by aligning business activities with global sustainability priorities. Companies may identify opportunities to develop innovative products, improve resource efficiency, and expand into emerging markets through sustainable practices. Governments and investors increasingly encourage organizations to contribute to SDGs through responsible investment and reporting frameworks. By integrating sustainability considerations into decision-making, organizations can enhance resilience, reduce environmental risks, and strengthen stakeholder relationships. Role of finance professionals in achieving SDGs. Finance professionals play a crucial role in integrating sustainability objectives into financial strategy and performance evaluation. They help assess the financial implications of sustainability initiatives, allocate resources effectively, and measure long-term value creation. Financial managers also support integrated reporting frameworks that combine financial and non-financial performance indicators. By linking financial decision-making with sustainability goals, finance professionals enable organizations to balance profitability with social and environmental responsibility, ensuring sustainable growth in an increasingly complex global economy. Sensitivity of forecast financial statements and future cash position to these policy decisions. Financial policy decisions significantly influence forecast financial statements, including the statement of financial position, income statement, and cash flow projections. For example, investment decisions affect asset levels, depreciation charges, and future revenue streams. Financing decisions influence interest costs, gearing ratios, and shareholder returns. Dividend policies alter retained earnings and available cash balances. Because these decisions shape financial forecasts, managers must evaluate how sensitive projected results are to changes in assumptions such as growth rates, financing costs, or dividend payout levels. Understanding these relationships enables organizations to anticipate financial outcomes and ensure that strategic decisions remain consistent with long-term financial objectives and liquidity requirements. Sensitivity analysis is particularly important when assessing the impact of investment projects on cash flows and profitability. Investment projects generate cash inflows and outflows over time, and their viability depends on expected returns relative to risk. Forecast financial statements must incorporate projected revenues, expenses, and asset changes arising from these investments. Changes in key assumptions, such as demand levels, operating costs, or interest rates, can significantly alter expected profits or cash availability. Managers therefore test different scenarios to determine how resilient financial forecasts are under varying conditions. This analysis helps ensure that the organization can maintain sufficient liquidity and continue meeting financial obligations even if actual performance differs from initial expectations. Dividend and financing decisions also affect the future cash position and financial risk profile of the organization. For example, increasing dividend payouts reduces retained earnings and may limit funds available for future investments, potentially requiring additional borrowing. Similarly, higher levels of debt increase interest obligations and can make financial performance more sensitive to declines in profit or cash flow. Sensitivity analysis helps financial managers understand how these policy choices affect liquidity, solvency, and key financial ratios over time. By modeling different scenarios, organizations can select policies that maintain financial stability while still supporting growth and shareholder value creation.